Hey friends, today we're diving into Singapore's economic outlook for 2025 and beyond. Most people think economic forecasts are just boring numbers that don't affect their daily lives. But I've got some fresh insights that show why these projections matter for your investment decisions right now. The latest survey from MS reveals some surprising trends that could impact your portfolio, and I'll break down exactly what you need to know in simple terms. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start with something that might surprise you. Singapore's economy is expected to grow by a solid 3.8% year over year in the first quarter of 2025. This is pretty impressive considering the global economic uncertainties we're facing. What's even more interesting is that this follows a strong 5% growth in Q4 2024, which actually beat economists' expectations of 3.1%. Think about it this way. Imagine you expected your investment to grow by 3%, but instead it grew by 5%. That's the kind of outperformance we're seeing in Singapore's economy right now. But what does this mean for the full year? For 2025 as a whole, economists are sticking with their previous forecast of 2.6% GDP growth. The finance and insurance and construction sectors are expected to lead this growth. It's like having star players on your team who consistently deliver results, while the rest of the team provides solid support. What's your take on these growth numbers? Do they match what you're seeing in your own business or investments? I'd love to hear your thoughts in the comments below. The most likely growth scenario, according to these economists, is between 2.5% and 2.9% for 2025. In fact, they've become more confident in this range, with the probability assigned to it increasing from 42% to 46%. It's like the weather forecast becoming more certain as the day approaches. One interesting thing to note is that the distribution of forecasts has become slightly more negatively skewed. What does that mean in plain English? Simply put, economists see more downside risks than upside potential. It's like planning a picnic where there's a higher chance of rain than unexpected sunshine. Now here's some good news that might directly impact your wallet. Inflation forecasts for 2025 have been revised downward. After seeing lower than expected inflation in Q4 2024, economists have adjusted their predictions. Headline inflation, that's the overall price increase you feel when shopping, is now expected to be 1.7% in 2025, down from the previous forecast of 1.9%. And core inflation, which excludes volatile items like food and energy, is predicted to be even lower at 1.5%, down from 1.8%. Think of it this way. If you were expecting your grocery bill to go up by $19 for every $1,000 you spend, now it might only go up by $17. It's not a huge difference, but every bit helps, right? The most likely range for headline inflation is between 1.5% and 1.9%, with a 46% probability. This is a shift from the previous survey, where economists were almost equally split between the 1.5%, 1.9% range and the 2.4% range. It's like the consensus is becoming clearer that inflation will be more moderate than previously thought. Are you feeling the impact of inflation in your daily life? Has it been getting better or worse? Drop a comment below and let me know your experience. Here's another positive sign. The unemployment rate is expected to be at 2.0% in 2025, which is actually an improvement from the previous estimate of 2.1%. A 2% unemployment rate is considered very healthy by global standards. Think of it like this. In a room of 100 people, only 2 would be looking for jobs. That's a tight labor market, which typically leads to wage growth and consumer spending power. For investors, this could mean stronger performance in consumer discretionary sectors and retail-focused REITs. Risks to Singapore's economy. Now, let's talk about what could go wrong. The economists in this survey identified geopolitical tensions, including higher tariffs, as the biggest downside risk to Singapore's economy. It's like sailing in calm waters but seeing storm clouds gathering on the horizon. Weaker growth in China and a potential resurgence in inflation were also mentioned as significant risks. Given Singapore's position as a trade hub, these external factors can have outsized impacts on the local economy. On the flip side, what could make things better than expected? The most cited upside risk was more robust growth in China. A sustained tech cycle upturn and milder than expected trade tensions were also mentioned as potential positive surprises. Have you been adjusting your portfolio to account for these risks? What sectors do you think will be most affected by geopolitical tensions? Let's talk about what the Monetary Authority of Singapore might do with monetary policy. This is important because it affects everything from mortgage rates to the strength of the Singapore dollar. Interestingly, only 16% of economists now expect MS to reduce the slope of the Singapore dollar nominal effective exchange rate policy band in April 2025. That's down from the previous survey. However, a larger proportion, 29%, expect a reduction in July 2025. For context, MS already made a move in January 2025 when it slightly reduced the slope of the SNEER policy band for the first time since March 2020. This is Singapore's way of easing monetary policy, similar to how other countries cut interest rates. Think of the SNEER policy band as the guardrails that keep the Singapore dollar moving within a certain range against a basket of currencies. When MS reduces the slope, it's essentially allowing the Singapore dollar to appreciate more slowly, which can help boost exports and economic growth. Looking further ahead to 2026, economists expect Singapore's GDP to grow by 2.3%, with the most likely range being between 2.0% and 2.4%. Headline inflation is projected at 1.8% and core inflation at 1.7%. These numbers suggest economists see Singapore settling into a period of stable, moderate growth with controlled inflation. It's like the economy finding its cruising altitude after the turbulence of recent years. What does all this mean for your investment strategy? Well, with stable growth and moderate inflation expected, Singapore stocks, particularly those in the finance and insurance and construction sectors, could offer solid returns. The relatively low inflation environment might also be supportive for REITs and other yield-focused investments. So let's wrap this up. Singapore's economy is expected to grow by 3.8% in Q1 2025 and 2.6% for the full year. Inflation forecasts have been revised downward, which is good news for consumers. The unemployment rate is expected to remain low at 2.0%. The main risks to watch are geopolitical tensions and China's economic performance, while potential upside could come from stronger Chinese growth and a sustained tech cycle. For investors, this paints a picture of a stable economic environment with moderate growth, generally a positive backdrop for equity investments, particularly in the sectors expected to lead growth. If you found this analysis helpful, please hit that like button and subscribe for more insights on Singapore's economy and investment opportunities. And if you want to dive deeper into specific investment strategies for this economic environment, check out my video on 5 secrets Singapore's richest investors swear by. It's a perfect complement to today's discussion. What's your take on these economic forecasts? Are you optimistic or cautious about Singapore's economy in 2025? Let me know in the comments below.